I think all of us, whether we're in risk assets or in commodities, hard assets, or precious metals, we're all kind of looking at the same things with relatively similar views in terms of risk. In a very, very dynamic world, you could say, changing world, there are bulls and bears in every camp, and I'll certainly give you my opinions. I mean, at 30,000 feet, we definitely are in a world that's changing, and I think most of us agree in more unknown ways. There's a lot of conflict as we're at 30,000 feet, kind of going from a globalist kind of backdrop of the last 10 years, which you could argue euphemistically is a cooperative model, to a more protectionist model now, or they would call neo-mercantilist, basically just my nation first versus a more cooperative globalist model. That's certainly, since the Trump election, has been in the headlines. And then we have examples of this conflict or this change in many forms. Tariffs and those policies, whether those are good or bad for the US or good or bad for the world, is a major debate. We have international relationships in the wake of those tariffs and other policies that are probably in global trade, probably at the worst since the 1940s, late 1940s. And if you look at academics like Mersheimer out of the University of Chicago, certainly out of the US, he would argue that our foreign policy since 9/11, which we're on the anniversary of just yesterday, has probably been a disaster, as he calls it, whether it's in Iraq, Afghanistan, Libya, Syria. We have conflict in terms of headline-making wars for the last few years, certainly the Ukraine, depending on what you look at, 1.5 to 2 million dead in the Ukraine. In Gaza, 50,000 out of a 2 million population dead. That doesn't include injuries. We've got issues in other parts of the world too, Yemen, Cambodia, Thailand, Pakistan, India. So there's a lot of conflict. And we all have different views on that. And my particular biases aren't important, but we can all agree, whether it's Israel, the Ukraine, whether it's trade, whether it's protectionism versus globalism, whether tariffs are good or bad, fair or unfair, legal or illegal. There's a lot of conflict and change in the global setting. And so what does that mean for markets? Well, usually that conflict, as Hemingway says, comes when nations are reaching a period of debt danger, where debt levels get unsustainable or dangerously high. And that is certainly a topic whenever you're talking about markets. Again, whatever the asset class, whether it's, again, stocks and bonds, commodities, and certainly currencies, when you have a debt crisis on top of a conflict in other areas, that's usually a perfect storm for higher risk and higher volatility. And the debt is not just a U.S. problem. We're at record high levels of government public debt now at 37 trillion and counting. Global debt is well past 300 trillion, which is 3 times global GDP. So there's a major mismatch in income or GDP versus debt. That's certainly very true in the US, which is the home of the world reserve currency, which affects all countries and all currencies. And it's also true in the world, in the G7 and the West in particular, of extremely unsustainable and high debt levels. And those are macro theses or themes that are unavoidable in any discussion we get into. In any theme that we talk about at the macro level, whether it's the DOGE spending cuts in the US or USAID spending cuts or tariff policies and reshoring jobs, whether it's stablecoin legislation, whether it's talks about gold revaluation, or whether we're talking about market risk in the US in particular, which is the major markets for the world, the S&P. All of these things and all of the problems and all of the desperation behind those measures stem from this original debt problem, which again, we can get into the weeds on. But to answer your question, these changing conflicts, this movement from globalism to neo-mercantilism, these conflicts militarily, these conflicts in trade, these conflicts in military risks, and these risks in the market, and these policy conflicts from tariffs, etc., and crypto and AI, all stem from what I think is the central thesis, which is a debt crisis, which is really unprecedented in the history of capital markets, certainly in the history of U.S. markets, and really in the history of global capitalism or any form of financial system. We've never seen global debt levels this high. So whatever theme we get into, whether it's the stock market or whether it's precious metals, gold and silver, it all comes back to this problem of debt, and these symptoms of debt and the policy symptoms from that debt are simply undeniable. So I would say that the debt is the main theme. It has a ripple effect on all markets, and the conflict and the setting of that debt, military conflict, trade conflict, unfortunately, are nothing new in history. Usually, when you have debt or a debt crisis, as Hemingway has famously quoted many times, when a nation's over its skis in debt, you see the temporary prosperity of what debt can give you, and usually that's ripping markets like we see now. But from that temporary prosperity comes the permanent ruin of currency debasement and war. And what we're seeing now is war and currency debasement, that is inflation, all around us in the headlines. And it's no coincidence. In fact, it's really history repeating itself. In my opinion, I've said this for the last couple of years, the US is already in an economic recession, and there's all kinds of wonky indicators to confirm that. There's the Psalms rule, which looks at employment numbers. There's wonky stuff out of the yield curve since World War II. It indicates we're heading into recession, the inversion and reinversion of the yield curve. There's a fancy thing called the Conference Board of Leading Indicators. There's the Labor Department data coming out of the Bureau of Labor Statistics. There's year-over-year auto sales and retail and manufacturing data. There's freight index data for train carrying of materials. Those are all, in my opinion, drastically negative for the economy. It has nothing to do with the U.S. market. We have delinquency rates on credit cards in the U.S. at 13-year highs. We have car repossessions at 13-year highs. We have manufacturing that's flat. In other words, a lot of data mining of negativity, but one of the most interesting and I think fascinating numbers recently is just from the Bureau of Labor Statistics in DC, which is subject to a great deal of criticism from me and a lot of debate. In fact, Trump just fired the head of it for being too negative recently. But the Bureau of Labor Statistics just came up with the non-farm payroll jobs numbers, and those can go up or down by 100,000 or 50,000. What's fascinating, and I don't think being discussed enough yet, the BLS's most recent non-farm payroll numbers were downward revised by nearly 1 million jobs, which is an extraordinary number. We've never seen anything like this. This is worse than what we saw in the U.S. in 2009, just after the great financial crisis of 2008. It's an extraordinary number. In fact, it's even gone into negative territory. 1 million jobs in one report, in one revision, just is unheard of. Coming out of COVID, we saw a huge spike in payroll numbers and the job numbers up to 800,000 right after COVID or right towards the end of COVID. Effectively, all of that is now gone. We're way below where we were even in the worst of COVID. To me, that is a sickening sign of an economy in stress, certainly a middle class in stress that is completely disconnected again from a stock market that's reaching all-time highs again, driven by basically 7 names, a highly concentrated market. We call it the S&P 500, but it's really the S&P 7 because 7 major tech companies, which are highly concentrated in AI investments, basically hold 40% of the stock market's market cap. To me, that's an incredibly dangerous and narrow stock market, which the risks are obvious and we can get into. But again, my point is the disconnect between the Main Street economy and a near all-time high stock market, I think, is very concerning, and usually that doesn't bode well for the economy or the market. But again, my short answer out of the US in particular, but I certainly see it in France and Germany and in Italy and in Spain, cooling labor growth, but in the US a dramatically falling labor number. And when you have this combination of inflation and currency debasement, which is coming from debt because you're monetizing that debt with money created out of thin air, the purchasing power of your euro and your dollar buys you less. You add on to that woefully poor employment numbers out of the U.S. You add on to that these indicators like car repossessions, credit card delinquencies, small business bankruptcies. It isn't me trying to be negative for negative's sake. It's just that these things are real. Manufacturing is flat. There's really no CapEx investments right now. It's looking very much like the early 80s when we were going into recession in the U.S. So again, it's not just looking for the bad news. It's looking at the math. And the math is for most Americans and most of the middle class, certainly in the US, but I see it as much in the Europe as well, but more prominently in the US. In every indicator that I look at, that looks and smells and tastes like a recession to me. So it's a tough time. Again, in a backdrop of a rising market and rising geopolitical conflict, and frankly, a great deal of distrust across the globe in leadership, whether that's in Canada, whether that's in Ireland, whether that's in the UK, whether that's in France or Germany and these coalitions coalition governments, whether that's the weaponization of political lawfare against certain parties we see in Germany or we saw in Romania, and even in the US, very polarized left versus right. This, I'd say, the divided states of America. And we just saw a brutal assassination of a right-wing political figure, pundit in the US, very tragic. Just highly polarized conflict, highly polarized distrust of leadership in the backdrop of a very distressed Main Street economy and a very ripping Wall Street economy, which is really sad because, the top 10% of American wealth own 90% of stock market assets. So there's a great deal of wealth inequality, a great deal of social unrest and stress, polarization, and frankly, very negative employment and recessionary indicators at the home of the world reserve currency. So again, I'm not trying to be doom and gloom or negative, but the cooling of wage growth, the cooling of employment growth, the rising of inflation, the rising of distrust for leadership, the decline of the purchasing power in your currency, your paper money, whether that's a euro or a dollar or Canadian, Australian, these are undeniable facts. And they're negative for sure. And I don't mean to be negative, but most people don't even need me to tell them this. They feel it. They feel it with the purchasing power of their currency. They feel it with the rise in costs of living and the disconnect between what they need and what they have available to them. I think that's fairly common to most citizens of the world right now, certainly in the US. Absolutely. And I mean, again, this depends on each person listening's own risk profile, own ability to take risk and stomach for risk. And I don't want to say greed, but yeah, if you can afford to take more risk, the mining stocks have a lot to offer. I do think there's generational wealth about to be made in this unloved sector for so many years, which has broken so many hearts. There are the Frank Justras and the Ross Beatties and the Rick Rules who have forgotten in an hour more than I'll ever learn in a lifetime about mining. They're brilliant mining executives who understand the Sturm und Drang of the mining space, and usually where they go, money follows. They just have to be very, very patient. So when you're picking a mining stock, you have to pick the right ones. When gold and silver get even more obvious to the world, and they're already becoming more obvious, these mining stocks, when the cost of production is still significantly less than the spot price of these metals, some of these are going to just do massive multiples. And so if you pick them correctly, you will be rewarded. The problem, notwithstanding that macro trend, the problem with a lot of mining stocks is the management and the operations. And so that's why a lot of the generalists on Wall Street don't touch the mining stocks because of the volatility. For years, certainly last year, mining stocks had the highest free cash flow in the S&P, but they were the lowest performing sector. And a lot of that is because of poor management, whether it's outright fraud or misuse of capex expenditure or distrust. There are, as Mark Twain said, in front of every mine is a hole in the ground with a liar standing in front of it. And so it's very important that you look for the right operational mines, not just the ones with the best science behind it or the best reserves underneath it, or the best geologists out of the best schools who can confirm the finds. It's the management, it's the use of the capital, it's the reinvestment of the capital, it's the dividends, etc. And again, that's where I'm not an expert, because I'm at the point where I'm not into speculation as much. I'm not looking for that life-changing investment. I don't say that smugly. I'm an older investor now. I'm not who I was in my 20s during the dot-com bubble. I'm more interested myself in preserving what I have, and that's why I'm more interested in just physical gold kept in a hole in the ground outside of the banking system, outside of the crypto system, outside of the tokenization system or anything that's trackable and seizable. That's me. If you're younger or if you have enough money that you can afford to take some risk and not be ruined by the loss of it, that's a very different investment. Or if you're extremely risk tolerant and you're willing to roll the dice and go into the mining sector, if you roll the right dice in the right mine and have the right patience, the multiples can be huge.